All right, welcome everyone. We are going to get started here right on time. So just some proper Zoom etiquette today for the presentation. I know as you join, you guys actually might need to mute yourself. So please mute yourself until actually the second half of our presentation where you'll be able to actually ask some questions. And we will be recording this to share out later today. So what to expect today and the format. Our first half of the presentation will really be around Startup Investing 101, which myself and Kevin will be providing. And then the second half will actually be having a panel of investors and founders joining us to kind of share their perspective as it relates to startups and investing. So just some proper etiquette as well. Disclaimer here, just know that we are not providing any legal or investment advice today. And as a reminder, if you are an investor, you should always investigate any and all opportunities as you consider any sort of investment or deal. The objective today really and why we are doing this, this is a new event. And the first part is we would love to grow and build a stronger network of support for our investors here in Iowa, but also beyond that. And two reasons why this is critical is because the process of raising capital for entrepreneurs, which I know we have many entrepreneurs on the phone today or on Zoom, it's really challenging and it's hard. So first off, we're trying to make this process simpler, more efficient, and faster. And the second piece for the investors is we really want to show that startup investing can be attractive and can be a nice addition, whether you're trying to diversify your portfolio, but also we're trying to show and educate how to make this simpler for everyone that wants to. And then the larger piece of why I think we're all on this call is it's really important to have a strong startup community here in Iowa, just because we know with entrepreneurial activity in our state, it creates jobs, it creates talent, and also the wealth that we hope to amplify. So that's a little bit of why we're doing this today. An introduction of who we are. So my name is Diana Wright, and I'm with the Greater Des Moines Partnership. My role is a startup community builder. And with that, I get to work with a lot of startups and entrepreneurs. And so that process could look like helping them find money, helping them identify investors, but also going through what could be their business model in their early days of understanding on how to find customers. I'm going to let Kevin introduce himself, but I also have had the opportunity to sit on two different angel networks here in the state. So Fin Capital, which is a women's angel network here in central Iowa, and also Plains Angels. So this topic today, and specifically we're really kind of targeting angel investing and early on, is really important, and happy to share what we've learned so far. So Kevin, if you want to hop on.
Yeah, thanks, Diana. My name is Kevin Bradley. I am the Director of Investor Relations at ISA Ventures. ISA Ventures is a $22 million multi-stage venture capital studio based out of Cedar Rapids that invests in Iowa-based companies in all different industries, but primarily the ones in that are prevalent in Iowa and the Eastern Iowa corridor specifically. But we invest in different stages and industries. My big role within that is to run the ISA Ventures Syndicate network, which allows the fund's investors and also accredited investors that are members of the Syndicate network to invest alongside the fund in ISA Ventures portfolio companies. So I get to meet a lot of great people around the state that want to invest in these startup companies. But before that, I was a commercial lender working with small businesses for a community bank out of the Quad Cities. But I also got my foot in the door into venture investing by being an investment analyst for a small angel group based out of the Quad Cities called Riverbend Angels. And love working with the founders and people in that ecosystem. So go to the next slide. What is angel investing? Quick history lesson. It got its origins on Broadway, where high net worth individuals would fund these theatrical productions to get them to opening day, and then get paid back later. Right now, what we're talking about with startup investing, where individuals invest their own money into privately held early stage high growth companies in exchange for equity and above market returns. We'll dig into that later. The SEC has some guidelines. So many of these financings require that angels be accredited investors. What does that mean? The SEC guidelines state that you have to have $200,000 in annual income for the last 2 years, $1 million in net worth, not including a personal residence, or a private business development company with $5 million in assets. And to make it a little bit more clear what businesses we're kind of referring to, they're ones that have the potential to deliver 10x returns through disruptive new technologies, potentially with a moat with IP protection. They're disrupting markets, incumbent markets, or they're creating new ones. They have new and disruptive business models that have the potential to scale very quickly. A little bit to make this point a little bit clearer, we may touch on a small business financing webinar down the line, but in terms of startups, what we're talking about today, angels and VCs in particular look to invest in C corps. That's for legal and tax purposes that we can touch on later. But typically, there's no near-term cash flow, maybe a vision, maybe something in the market, but has to grow into cash flow. You're waiting on a big payout at the end, no dividends or share in cash flow. You're waiting for a big payout 5 to 10 years down the line. These companies have high growth rates, can scale into very large markets or internationally. And there's an expectation set when you invest in one of these startup companies that there's going to be a liquidity event, within a 10-year period. The earlier you go, the longer that period is likely to be. And a liquidity event refers to they either get acquired by a larger company or an IPO to the public markets.
Yeah, so moving along to why do people invest in startups? I think it's kind of critical to think about you get to have this impact early on with early stage companies and entrepreneurs in your community. And I know we're going to hear from our panelists later today on why they invest, but that's really a key piece to it. Other reasons why investors will choose to invest in early stage companies and startups is they might actually have something that they can lend of expertise or knowledge. So a good example might be if someone has been in product development for over 20 years, they might then have an interest to help startups think about how do you develop products through different stages of their business. Or even specifically, if someone's in the agriculture industry, they might look at egg startups and be able to kind of cast their network and help really speed up those success for the entrepreneur. And then the last piece here is, of course, really important to remember is the potential for outside returns of your investment.
So where in the cycle, in a business's life cycle, are angels prevalent? Here's some terminology that you'll see as you maybe already have seen, or if you're new to startup investing, terms that are going to be thrown around quite a bit. Where the angels are more prevalent in the earlier stages of a company's life cycle. So the earliest is a company that may be very fledgling, the founders working full time, has a side hustle that they're trying to get off the ground. That's where sweat equity and bootstrapping comes into play. Sweat equity is the labor that they're putting in to get the vision off the ground. Bootstrapping, meaning that they're using their own personal money or operating revenue from early sales to keep the business afloat. But eventually they'll scale and potentially need more money. That's where family and friends, which literally means people that are investing money to see your vision through, or founder's vision through rather. And that's definitely where angels can provide some value and expertise if that's in the field they know. But also in the pre-seed and seed levels are definitely stages where angels can to get in early and provide value for that company. The later stages, Series A, Series B, even seed. ISA Ventures, I know, is involved in pre-seed and seed levels as well. But Series A and B is where institutional money, professional investors will be highly prevalent and be putting in large amounts of capital.
So understanding there is a whole process as you think about investing into a startup. And it doesn't mean that you have to do this exact process. I know there's some experienced angel investors that they might know the industry or the person really well, and they could skip a lot of these pieces to what that process looks like. So it really varies based on each individual or also the network or fund. But I think it's kind of important to talk about this just as if you are new to this, it's good to see how it might be different than other investments. So of course you have to find where are the entrepreneurs and the entrepreneurs, the startups and companies that are growing and scaling, and what does that need as they think about investment. There is screening, which I know Kevin's going to talk about here in a little bit. You might actually hear a pitch from an entrepreneur, and then that might go into due diligence if you are interested in learning more about that deal. There is negotiation and kind of setting the terms. A lot of times the founders are doing this, but depending on the stage, there might be venture that comes in and really defines what those terms look like. And then there's syndication opportunities. So syndication just means that if you are an individual investor and you would like to invest with others, you might syndicate a deal and together go in on that and create a special purpose vehicle. And then there's documentation, which is really the legal side and the actual flows of the deal. So,
yeah, go ahead and do that.
Muting a little bit. Okay, make sure you do stay muted as we're in this presentation. So next thing is sourcing. How do you actually find these deals? And the first thing is, of course, from founders and entrepreneurs, knowing them in your network. Also thinking about angel investor groups. If you yourself don't want to have to go through that whole process, it might be advantageous of you to actually join an investor group. A lot of times they handle that organization, finding the deals and organizing those pitch presentations. It's important to talk about venture capital. I know Liz is going to be joining us later on, and there's certain funds that you can follow, but you could also be a limited partner or an LP to a fund if you want to invest, a larger amount, but let that team really figure out that whole process, similar to ISA Ventures too. And a lot of these on here on this list, you can kind of look at here, whether it's equity crowdfunding, syndicates. There's accelerator demo days that you can actually attend in person or online. And I would just encourage people to really get involved and engaged as it relates to thinking about investments and finding potential entrepreneurs to partner with. And then the last thing I want to mention on this list is the entrepreneur support organizations. So there's many all across the state. And they are typically the practitioners. They're the ones providing programming for entrepreneurs, depending on the stage of their business. And a lot of times they offer mentoring opportunities. So just consider that also as you think about sourcing deals.
So what do you do here? You've built this network. You've attended a lot of these networking events that were just shown on the last slide. You're starting to see a pipeline of deals. So how do you screen and filter down the ones that you want to do further due diligence on? Maybe the first step is, does a company fit your thesis? Are you looking for a specific industry, a certain type of business, or is it one that you have an edge in because you know that particular vertical and could be of use? Maybe that's the first one, but whether you have a specific industry or a generalist, I think it's important that the company's team, product, and market are reasonable and exciting enough for you to take it to the next step. And so we'll kind of touch on those three real quick. So the team, is their vision compelling, and do you believe that the team can execute? Better yet, do they have the qualifications to execute? Are they For example, were they an early employee at X company that brought Y product to market? Were they the first two salespeople at a organization that got it to the first $100 million? Do they have those qualifications? But I mean, it could just be something where a founder has a vision and no product in market, but they may have a particular insight. They found something that brought a lot of use to them. Example of that would be the story of Slack, how they were a gaming company that actually failed, but they used an internal communication process that they made consumer and enterprise facing, and is now worth billions. The next would be product. I put oxygen aspirin jewelry here. Is the product oxygen? Can the customer not live without it? Is it aspirin? Does it relieve a pain? Or is it jewelry? Is it nice to have but not really necessary? The last would be market. Why now? There's a lot of great products that failed just due to timing. Why is now the right time to penetrate this market? And then also insight and strategy on how to penetrate that market. If you look over to the right, the top down or the bottoms up approach. Top down means, and you'll see these on a lot of pitch decks, but top down approach is starting with a macro level, the total market demand for that product or service, going down to the serviceable addressable market, the segment of that larger market that you can reach, and then finally the bottom where you can address them. The one that's more preferred if the founder can do it is the bottoms up approach, which is taking specific customer data that they've found in the market and people that are buying the product, finding the how many customers are out in that market and addressing that specific category. And then the last are three types of market categories that I found interesting, actually from another VC. Market creation, meaning is this product or service creating a new market, or market expansion? Is it expanding a TAM expanding the TAM to a lot more a larger customer base, or market theft? Is it stealing customers from an incumbent because their product is out of date and slow and not useful anymore?
Yeah, and kind of moving over to due diligence, which is very similar to the screening, is just really understanding the process. So everyone has different due diligence. Some are very, very thorough, while others might just be even what Kevin just said, like, can it answer these three things? And therefore, is it an opportunity for me? But due diligence is essentially you're trying to verify these key assumptions. And, there's a lot of different links online that are great. I know we're dropping one in the chat that really kind of goes through what Kevin just mentioned, is identifying, have you looked at the product market fit, the go-to-market strategy, the financials, the legal terms? So that's really critical. But also, it's trying to erase any avoidable mistakes. Hopefully you as an investor, whether you are coming as either a prior entrepreneur or founder, you might actually be able to really help them try to avoid those mistakes. So it's knowing that, looking for that, but also being kind of kind, whether it is a first-time founder or, second time, third time, it's just identifying, are there mistakes and how can we avoid them? Something I want to note is that there are terms, deal room is used quite a bit, whether you're in venture capital, but also potentially as an angel investor. And so what a deal room is during that process of due diligence, the founder might share with you their deal room, which is just a virtual room of data. It could be a Dropbox folder, and it essentially has the confidential documents of the company. So whether that's different legal terms, if it's intellectual property, if they have employees, it might show those different agreements. But just kind of keep in mind that's what deal room means. And if you are really early, it might not always be appropriate to ask for a deal room depending on your check size or what the stages of the entrepreneur. Other ways that you can test due diligence is, of course, talking to customers. And so if that entrepreneur and the company does have customers, that's a great way to kind of do a reference check if they will share those early on customers. You can certainly seek out experts in the field. So if it is in agriculture technology, maybe you go through those different channels and understand, is this something that is a big problem and potentially the right solution for it? And then you can use the products or services. That's a great way to really understand what you are investing in, if that is available. And last thing I would just mention, as I have been part of different angel network groups, is there is sometimes the option that you can have other due diligence shared with you. And so, for instance, if ISA Ventures does invest in a startup, and then that startup entrepreneur is presenting to your group or presenting to you, you might be able to request that due diligence and really kind of see what they've gone through to make that investment.
All right. What a couple key terms that you're going to see as you do due diligence and in pitch decks is the valuation. This is the value of the company that will determine your ownership, but there are two different types. Pre-money valuation is the value of the company prior to investment, and post-money valuation is the value of the company after it receives the money and investments. Pretty simple, but pre-money valuation determines the price per share, whereas post-money valuation determines the ownership stake that your investment will be, the investment stake of your investment. So, for example, you're raising $1 million at $4 million. The founder's raising $1 million at $4 million pre-money. You put in $100,000. That's a 2.5% stake. But post-money, it's 2%. So very big difference, especially if we're talking about returns at an exit. And speaking of returns, again, early stage investing is high risk, high reward. So we'll kind of give some scenarios here. Starting it out with S&P 500 and bond yields, which are typical for 401ks and what your financial advisor provides and most of your net worth may be in. But S&P 500 historically is at 7% since 1928, I believe. So estimated time to double that money is 10 years. Compare that to a bond yield. This was last week, so I know they changed. 10-year treasury backed by the full faith and credit of the United States government, 3%, which will take about 23 years to double your money with that. So if we go on to the next scenario, which if we have a liquid net, if an investor has a liquid net worth of $2 million, they decide to put set aside 10% of that to put into startups with an average check size of $10,000. That's 20 companies they could have in their portfolio. And Saraf has some really good information again, but they provided a breakdown of different outcomes for exits and return on capital. It's very realistic that 10 of those, especially at the early stages, could go to zero. That's $100,000 and 5% of your 5% of your liquid net worth that may go to zero. That's highly possible. But if we look and with a diverse portfolio of the different breakdowns that may happen, and go all the way down to the bottom, you only need to hit one big one to return all that money. If we look at the scenario of 5 1Xs, so five companies return that $10,000, you're only risking 7.5% of your net worth, but have the potential for a very large upside. So your downside's mitigated and known, but scenario 2, it is a power law game. So angel investing and venture capital investing certainly determined by power law. And what that means is that most of your returns are going to be driven by one or two companies primarily. So this second scenario, a check size of $10,000, you have a post-money valuation of $10 million that you invested in. That's your ownership at that time of investment. The company decides to exit, gets acquired by Amazon per se for $1 billion. Your ownership at exit, because they have further financing rounds, you get diluted down to 0.03% at exit. You returned 33x of that money and get returned $330,000. So look, very large upside on this money. And again, downside is mitigated, and worst you can do is 10% of your net worth can be lost, but very high upside.
So kind of shifting gears from the valuations and what can happen, I thought it'd be important to know, what does the venture deal activity look like in Iowa? And this chart here just shows over the last 5 years, the number of deals by each year, but also the dollars invested in those deals. And so you can kind of see here, 2021, we had quite an increase in the actual dollars invested in our startups. And that's kind of probably likely that there was more Series A's or Series B rounds that could have happened. And sometimes it also means that there are certain fields, like for instance, medical technology, where there are much bigger raises. But it is good to see, and also kind of indicates a healthy deal flow that's been happening, is that this number has increased. Deal size, or actually deal number, has slowly increased over the years. And we are tracking now to see what 2022 will look like. And those numbers should be out at the end of this year. Also kind of here to note is who are the most active investor funds in Iowa. And these are active by meaning they're investing in Iowa deals. We do have others, but this is kind of important to know if you are looking to kind of follow along. It's helpful to go after ones that have already investing currently. Other macro trends to look at, as you guys might all know, the last 2 years have been really interesting to watch as it relates to business entities and new business creation. So the Economic Innovation Group has shown that over the last 2 years, the activity with businesses getting created has far outpaced the last 20 years. And I think what's interesting to know as it correlates to this is about just under half percentage, so just under 50% of $50 million venture funds. So anytime that a startup is, raising $1 million or more, it will typically occur in the first 2 years of business. So this is just a really key trend to kind of follow, because it shows that the likelihood of venture capital activity is going to be high, and there are those opportunities to really invest in our startups here in the state.
Following up with macro trends, this is just venture in general at the angel and seed stage, and what those the market valuations are right now. In seed stage and angel stage companies, the valuations have maintained, not only maintained, but increased pretty drastically since 2021. And I think it's up to 12.2. Doesn't really give a great figure right there, but $12.2 million pre-money. So it's up 30% from the previous year. And this is as of Q2 2022. And this is probably due to a presence of large multi-stage firms and non-traditional investors in the seed stage, alongside growing number of micro funds to keep the market competitive. Probably we'll see some pressure on that as 2022 progresses, given inflation, rise in interest rates, and public market multiples and IPOs dropping. And the early stages are going to be the ones that lag the most. But right now it's very competitive, and valuations are holding up. Last thing, touching on kind of the process is the investment instruments that are common within angel investing and how you invest in these companies, and the terminology there. So we'll talk about it at a very high level, and drop something in the chat to learn more. There's two convertibles that convert into shares during a triggering event or a priced round. Those are a SAFE, which has been popularized by YC and created by Y Combinator, which is a very astute accelerator out in the valley and on the coasts. The other one's Convertible Debt. Both of these instruments are very flexible. There's not a lead investor that's required. They're fast and affordable, and they usually have some sort of cap, a valuation cap or a discount to incentivize investors and to kind of know where their equity stake is going to be once it's converted. And then you have a price round, which gives clear terms and certainty of dilution, more protection and rights for investors. But it is more expensive and more upfront accounting. Usually requires a lead investor. So you see these in a lot of venture capital rounds when institutions come in, but they also help with raising more capital quickly for these growing companies.
All right, so just a few expectations for if you are inspired to invest, or maybe you're an existing investor. Just kind of keep in mind, I'm not going to go through all of these, but I know, like, number one, something that comes up with a lot of entrepreneurs is the frustration that angels sometimes might have the expectation of venture capital. And what I might mean there is that, you know, an angel could come in and say, you know, I'm looking for 5 years of revenue. And that's just probably not going to be the case. And even maybe at the VC level, but it's just kind of understanding the stage of which you are investing in the startup. I always like to set the bar high. So whether you are an individual investor, you're a fund, or an angel network, make sure that you are communicating fast and often. So if you know that you've seen a pitch and the entrepreneur is waiting for your feedback and also your interest of the deal, you need to communicate within a week, I would say, is a good time frame of if you are interested or not, and then therefore if you're going to go into that due diligence process. It can be really frustrating on the entrepreneur side. I have seen some cases where they waited 6 months to understand if the group or the individual was interested, and that can just be really long. But it also can mean you can lose out on that opportunity. And then I would also kind of touch that we've mentioned startup investing is all about the long game. So making sure you are diversifying with the number of investments to kind of over the long term and build your ROI as it relates to this kind of investing. And last thing I would mention is that it's important to remember that you are working with startups. So just as all the big Fortune 500 companies or any kind of company on the Wall Street Journal, stock exchange, know that they all started out as an infant, and kind of keep that patience in mind as you're working with startups, that it might take, 5 years, 10 years for them to see that maturity. So just kind of remembering the why, and of course, that really involves the impact that you get to have within startups.
Yeah, some great resources, and we'll link all these later as well. But some great resources just to read and listen to get familiar with a lot of this terminology and what we've and strategy that we've laid out here. There's an endless source. I'm trying to work through all of it myself. Listen to podcasts every day, learn through osmosis that way, and then reading a lot of books. The Venture Deals is a great one to start out with, that lays out from the founder side and from the investor side what to look out for during these deals, and be smarter than your attorney. I think that's in the title. And Angel is a quick one to, if you are interested in angel investing. Jason Calacanis and Molly Wood have a great podcast as well. They only take 1 day a week off, so it's every day you can listen to something new in the startup space, and just really get acquainted with a lot of things. And if you want deep dives, my favorite podcast is Acquired. They talk about tech companies and the business models behind that, and rank them and grade them. And some great local Iowa newsletters. Diana has a great one, the Startup Iowa Hot List. So subscribe to that if you haven't already. X Startup Engine, Next Level Ventures, IADA, all have great information.
All right, and so as it relates to resources, I think it's important to know who are the existing funds and also the existing angel networks. So if you are at all interested, whether it's being a limited partner on a fund, I will say, I know there are a couple of new funds coming up within the next 2 years, whether it's, for instance, an Iowa fund and they're looking to develop their second fund. Those opportunities exist. So just know that these are some of those partners. And then also the angel networks that we've talked about quite a bit. they are also opportunities for you to get involved. So we'll share this as we said, but all of these hyperlink out to the websites. So we are going to switch gears now. And this is really your time for questions. So if you've thought of any questions as we've talked today, please start sharing those in chat. We are going to be monitoring those. But I first would like our panel to, first off, if you can come up, show your video, unmute yourself. They're each going to share who they are and to start with their journey into startup investing, whether they are an investor or a founder. So with us today, we have Liz Keener. She is with Next Level Ventures. We have Tej Dewan with Plains Angels, and then Andrew Kripalani. He is the co-founder of Workhound and also an angel investor. So we'll give them about a few seconds to get on. And Liz, if you can then get us started.
Yeah, thanks, Diana, and good afternoon, everybody. Glad to be here. My name is Liz Keener. I'm an associate with Next Level Ventures based in Des Moines, Iowa. I got my start in startup investing through venture capital. So I graduated from the University of Northern Iowa in 2013, and Next Level Ventures did not exist at the time. Venture capital did not exist in Iowa. So my first role out of college was with an equity crowdfunding firm in Austin, Texas. I got to assist with investor relations, deal syndication, and diligence on early stage companies that were fundraising on our platforms and transitioned into traditional venture capital. From there, I joined the team at Next Level in December of last year, where I lead all of the deal sourcing and diligence for all of our Iowa deals. So to date, we have 25 Iowa portfolio companies and 2 funds with about $90 million of assets under management that invest specifically in Iowa. We invest anywhere from seed to Series A and oftentimes growth stage as well. So thanks for having me.
Thank you, Liz. Tej, if you want to jump on.
Sure. Thanks, Diana. So my start in investing in young businesses started with my own first $1,328 about 30 years ago in my own first company. But in the current rendition, if you would, Plains Angels was formed because we knew that startups in our community were having to seek out people individually. So in May of 2012, we launched Plains Angels as a network of investors in and around central Iowa. So Mike Caldwell, Sheldon Oringer, Chris Sackett, Paul Juffer, and JD Genezer, along with Christian Renault, were in the room, and we created this little entity that has persisted over the last decade, investing in over 50 companies at this point in and around the Midwest, connected to what Laura Klassen and I at that point called the Midwest Angels Syndicate. Laura of Nebraska Angels, Dave Russick of Gopher Angels out of Minnesota. So this 8-state upper Midwest group of angel investors works together with a no financial arrangement amongst us, just a group of friends. And so at this point, I remain both an individual angel and then also currently running Plains Angels solo. And glad to have so many of the members present here today. Thank you.
Thank you, Tej. And Andrew.
Yeah, so my name is Andrew Kripalani. I'm, as Diana mentioned, I'm one of the co-founders and the CTO of Workhound. Workhound is a company providing employee retention and feedback services for workers that don't sit at desks. So we do most of our business right now in the trucking industry, but also in adjacent supply chain and logistics, basically providing a voice to those workers in those industries that typically are fairly underserved. So we've been around a little over 7 years. We founded the business here in Des Moines, Iowa. There's a whole, 7 years worth of history there, obviously. As co-founders, myself and Max Farrell, went through the early stage process, ultimately unsuccessfully tried to raise once, then ultimately raised pre-seed, seed, and earlier this year we announced a Series A from a growth equity firm. So it's a little bit different than maybe a traditional VC investment. But so as a founder, I've been through that fundraising process several times. I certainly have a perspective there. Also, as Diana mentioned, I would say I'm more of an aspiring angel investor. As part of what this Series A is, I'm exiting Workhound, and so I've started attending the Plains Angels meetings, but I haven't written a check yet on that side of the table. And so my perspective mostly comes from the founder side of things. Hopefully that's helpful, and thanks for having me.
Awesome. Thank you, guys. So kind of to start with, Liz and Tej, if you can kind of first share, why do you guys choose to invest in startups? You could be spending your time doing many different things. I know, Liz, this is your full-time role, but just talk about why you personally are invested in this area.
So for me, at least, Diana, this is a part of my portfolio. If I look at $100 in my portfolio, unlike what Kevin shared, I choose to allocate 5% of my assets into high-risk capital. I choose not to go into energy or real estate because those risk assets don't appeal to me. Not that they're bad, they just don't appeal to me. So I allocate 5% of my portfolio across a diverse set of startup assets. I use the title angel investor for the second word. I'm an investor. This is neither charity nor community building for me. It is purely a capitalistic intent to make more money from the capital I'm investing, period.
Yeah, I guess from my perspective, I've always been so intrigued at the intersection of investing for, capitalistic and ROI reasons, as Tej has pointed out, the intersection of that and entrepreneurship, and really helping entrepreneurs, maybe it sounds cliche, but change the world, right? I think it's really interesting to be able to get to look at so many technologies that have an opportunity to disrupt markets, and to get on board with founders who have passion and inspiration on solving problems for people. And that's always just been kind of my ambition behind why I've pursued venture capital as a career and, a full-time role. And, from an economic perspective, right, I think small businesses and startups are the greatest job creator here in the US. So if we can be a component of that and a driver of that, then, I think that's just been helpful from both, a wealth building perspective, but also an economic development perspective.
Awesome. Thank you. And I guess, so we had a couple of questions early on come in before we started the presentation. And so I do want to make sure we ask some of those. So one of them was, how much communication should a founder, share to a back and forth with an investor? And so Andrew, I might actually have you first start with this. What's been your, experience with communication and investors at each stage?
Yeah. So first before I start answering anything, I want to caveat, I tend to speak very declaratively and have a strong opinion, but this is just one perspective. Please take everything I say with that grain of salt. So that being said, typically we would try to get an investor update out. We started out on a monthly cadence. I think that cadence kind of flexed ultimately to more like a 6 to 8 week cadence. But really, anytime the companies that we've seen, whether we've gotten feedback from our investors or the companies that we've seen as peer companies or whatever that are updating their investors, probably no longer than quarterly. And that update should include things like financials, governance, team growth, product growth, those types of things. But typically it's going to be, 2-3 pages. You should be informing your investors of sort of progress of the company. But for the most part, as a founder, like you don't have time to do that type of deep dive update with each individual person on the cap table. So especially at the pre-seed and seed stages, being comfortable with that level of information as an investor is really important. And we at Workhound we're fortunate to have very, very accommodating and reasonable investors. Some of the folks out of Plains Angels are investors are in Workhound. And so that cadence of, between monthly and quarterly with quality content is a perfectly reasonable expectation, but like, don't expect a phone call every week, because you really want your founder focusing on the business, right? Because each business has 4 resources. You have time, capital, equity, and people. Time's the only one of those resources you cannot get back. And so your founder's time focused on the business is the most valuable thing. And so being cognizant of that as you expect your communications. That'd be my feedback on that.
Anyone else? Otherwise, I can move on to the next one.
I'll add just a brief to what Andrew said. Angel investing is not a once and done. The seasoned investors will typically put no more than 30% of their capital into that first set of rounds of money. The seasoned ones know that 70% of their money sits as dry powder for future rounds that the startups will need. Guess where that 70% goes? To the founders, who they know how the companies are being run. So whether it is a monthly update, whether it is a monthly text that says, here's what worked really well, here's where we screwed up, here's what we're fixing. That way the investor remains connected, and the dry powder tends to go in direction where the investors know their money makes a difference. The companies that have chosen to go completely quiet, I have many in my portfolio. When the second round comes, no matter how good, I just don't trust it and tend to hit delete rather than even file on the message, if that helps.
So another question that we got, and I know we have a couple of entrepreneurs on this call. So the question is, how do I know if I should be bootstrapping my company or if I should consider raising capital? And Andrew, if you have maybe kind of a first thought to this, and certainly open this up.
Yeah. So the first question you have to ask yourself is like, what are you actually optimizing for? Like, do you want to build a business that is, are you shooting for the stars? Are you trying to build $1 billion business? Or are you trying to build something with it doesn't have to be $1 billion, but like an outsized outcome? Like, do you want to go do that thing? If so, capital is going to help you go faster, farther. Generally speaking, again, those 4 resources, right? Money is actually the most fungible of those resources. There's a bunch of different ways to add capital, whether that be sales, investments, loans, etc. But what you're doing with that capital is you're using it to buy time. Anytime you can solve a problem or move quicker because of capital, you're saving time, and that's how your business ultimately becomes very large, is by using money to buy time, essentially. That's not the right model for every business or every person. And so, like, if the founder wants to build a Main Street brick and mortar, that's great. Like, that's a perfectly viable, useful, valid business. It shouldn't be a venture capital funded business. And so you really have to think about from what you as an entrepreneur want to do. Again, neither one is right or wrong. They're just different, and understand which one you're doing.
I think that sums it up really well. So I'm going to start asking some questions in chat. So I know Sue asked here, she's a woman entrepreneur building a business in rural Iowa. And how can there be more investment opportunities for women? And even I would throw in minority founders. I know in venture capital, it's just under, I think, 2% that women and minorities actually receive in the whole funding landscape. So what are some ideas and thoughts behind how Iowa could help improve this?
I would start by saying, don't sell yourself short. Neither rural nor woman-owned is a disability for the startup. It is actually an asset. So start with a position of power, not with a position of subservience. Second, an investor is looking to multiply their money. Show them how you're going to multiply their money. The way to say, would you invest in rural is like seeking a handout from government. The alternate way to say it is, I have such and such idea or such and such product, and the addressable market is this type of a revenue potential. And I'm looking for investors to get to that revenue potential. So that's the way I would begin, to go with a position of power rather than a disadvantage.
Awesome, thank you. And the next question is, what are those industries that are most prevalent in Iowa that early stage startups are part of? What does that scene look like for you guys?
So for us, I think it's a majority of, ag tech, insure tech, the manufacturing technology. We've got a little bit of ed tech and health tech in the eastern corridors and at the University of Iowa. And that's been really what the majority of our portfolio makeup has been.
Plains Angel's first investment was, Sue, for that, to your question, was in a company in Carroll of all places. That was in ag tech. The second one was in med tech. Our latest one is in social entrepreneurship, social media. So the Iowa landscape is diverse. The companies coming at us are diverse. So the portfolio that we build is fairly diverse. We are not just stuck on one or a small subset of industries. So we've been lucky to have a truly diverse portfolio.
I would add from a founder perspective that it is becoming almost ubiquitous for software-enabled businesses to be distributed and remote. There are so many opportunities and tools available now to sort of uncouple your startup from geography a bit. And what I think that's going to do for a couple of things is it's going to change some of the state-based landscapes, and I think we're going to have to start to think regionally. But it's also going to bring the availability of various different types of startups to you as an investor network, and it just requires some people doing the work to connect those startups into these networks. There's a group called Comeback Capital out of Ohio that they're currently putting on, or soon they'll be putting on an event called like Connecting the Coast to the Heartland. And so there are actually a lot of these kind of more regional and local groups that are starting to try and take the fact that like network and geography have kind of become uncoupled, and then bring those network effects into their capital bases. And so I think going forward, your opportunities are only going to get more diverse for the companies that you can see, not less.
Mm-hmm. And then it looks like Ben's question is, what's the current landscape for education and events for our investors to connect in Iowa? And actually kind of a larger question is, what are the gaps that might exist from your perspectives?
Diana, I'll throw this in the chat, but Kevin mentioned Venture Deals as a book. That book is gold, right? Even bigger, if that is gold, the diamond is the online course available for free. So Kaufman Fellows and Brad Feld make that course available multiple times a year. I would say that subscribe to that class. It's free. It's going to take you about 8 weeks of lessons and exercises. You're going to learn so much out of it, whether you're an investor, an entrepreneur, or anybody really on this particular session. I've taken that class 3 or 4 times. I'm a practitioner in the field, and I learned something new every single time. So I'm signing up for it. I think, Andrew, you and I've been on a on a study
Yep.
group together. It's worth it. You're going to spend time. The first couple of weeks, you'll spend 1 or 2 hours in the week. Toward the later part of the class, as you do the exercises, you might spend 3, 4, 5 hours going through the real work. It's worth it, and it's free. So I'd recommend that.
I would absolutely second that. That course, like I've read the book as well as haven't, taken the course. Whether you're a founder or an investor, especially at this level, at the angel level, when we start to talk about like founder dynamics and stuff like that, as you get into later stages, the institutional investors, Liz, for instance, that's all Liz does. Like it's her whole job to do deals, right? As a founder, you do it once a year, once every 18 months, if you're on some of the fastest tracks. And so just spending the time to educate yourself. And I would say that most of us as angels will probably be on that cadence. You're going to do, 2 or 3 deals a year. You're not a venture fund, and most venture funds are only doing 10 or 12, depending on their scope. So spending that time to educate yourself, because you're just not going to have the same repetition in your daily life about it. Whether you're a founder or an angel is just going to help you, operate with a little more intention, a little more understanding, and frankly, a little more appropriately set expectations. I think, Diana alluded to this, but one of the things that was very challenging for us as founders was early on finding angels with appropriately set expectations for the business. And I think that's a really, really big area of learning that our ecosystem can do. And this is one way to do it really well, is that venture deals course.
Yeah, I would second third, the venture deals. And then additionally, Angel Capital Association has, free resources in their education section. They have regional events and conferences that they put on. So they're a really great resource for kind of just getting into angel investing, understanding it. They've got sample term sheets on there so you can kind of better understand, if you're going to invest in a round, what, financially, legally, does that look like for you? And then I would also say, all of those podcasts. So as an angel investor, you can't just narrow your scope to angel investing, right? Because when you're looking at these companies, you've got to be thinking about who writes the next check. And as an angel investor, that's an institutional investor, hopefully, right? And so you've got to be thinking about what are the things that these companies need to do to get to a place where they're attractive to institutional investors. And so understanding that as well is really helpful. And 20-minute VC, their interview, 20-minute conversations with VCs talking through their thoughts and perspectives on why they're investing, what things they're investing in, what's exciting to them, so you can kind of understand macroeconomics. And then there's the acquired conversation that Kevin pointed out, which is like, what business models are like revolutionizing markets and industries, and why are they attractive acquisitions, down the road. And so you're kind of thinking about, it gets you thinking about a more holistic picture of angel investing than, just investing in the stage that they're at. It's trying to understand how will this company progress, and how do I get my money back, and what are those potential risks and funding milestones that the company will have to overcome, and what kind of bet am I making now that gets that company there hopefully later.
Awesome. And so I'm going to wrap us up with one last question. But certainly if people have other questions, feel free to drop that in chat, and we can always get some responses following this presentation. So my last question is, what does the process look like, whether it's for a venture fund or an angel group, to get involved? And so Liz and Tej, if you can kind of explain that, like, what does that really look like to someone that might be interested in taking that next step?
Diana, I need to drop off, so I'll be very
Okay.
quick. You can just come to plainsangels.com, the website. There is a place for entrepreneurs to apply. and investors to connect to the network. Your request will come straight to me either way, and I would be happy to respond. And I apologize, I do need to drop off for a next meeting. So thank you all for being here. And thank you, Diana, for the
Thank you,
invitation.
Tej. Appreciate that. And I would probably just add on, just because I have sat in on those conversations and meetings, is it's a monthly meeting usually for a lot of angel network groups. It's the same at Fin Capital too. And you might hear two different presentations from different founders. And a lot of times after those presentations, the entrepreneur leaves the room. That's actually where you can kind of dive into understanding what's the interest of the group and if there is. So that's just something to kind of know. And I know in our resource list and our link to all those different types of funds, you can kind of see what might be a good fit for yourself, depending on where you're at. And now, Liz, I'm going to hand it off to you to kind of answer that question from a venture capital fund.
Yeah, so my number one piece of advice to founders who are raising capital is to start early and start building relationships early. Especially here in Iowa, it's one big room, right? And so when it comes time to needing funds, to Andrew and Tej's point earlier, the more relational communication I've had with you before we might be a fit for funding, the easier it is for me to write a check come time for that. And so I try to make myself as accessible as possible. I'm usually at 1 Million Cups all of the time. I'm one of the organizers. So, come talk to me in person, reach out to me via email. We also have a contact form on our website. So even if you don't think you're a good fit for an institutional investor now, but that is the route that you want to take, make sure, you don't want to waste an investor's time either. So really, really purposefully decide how you want to build your company, the funding routes you want to take. And if institutional VC is right, then I would say build those relationships early and don't hesitate to reach out and start those conversations.
Great. And also, Liz, can you share, like, if you're an investor interested in maybe being an LP, what does that look like usually?
Yeah, so, oh goodness, it's been a while since I've been on the investor relations side of things, but usually if you want to be an LP, those relationships are built a lot of times through referrals. And so if you're interested in investing in a fund in order to diversify your risk capital, then, reach out to me. I can get you in touch with the right people. There's people like Kevin at ISAV that are kind of tasked with those investor relations. There's typically an investor relations person within institutional funds that kind of manages that. So look for those people. At Next Level, we have all hands on deck. So feel free to reach out to me. But those processes, that's a little bit harder to get into, right? Because funds typically raise once, maybe every 3 to 4 years. And so you've got to keep an eye out for kind of fund managers that are looking to raise their funds. So a lot of times you've got to either, know somebody who kind of is already an LP, or keep an eye out for people who are raising maybe first-time funds or a second fund, third fund, et cetera.
Mm-hmm. Perfect. Thank you, Liz. And thank you, Andrew and Tej, and of course, Kevin. So to wrap things up, we do have upcoming events. I know Ben highlighted in chat, kind of keep the conversation going, but depending on where you're at in the state or even outside of the state listening in today, these are some events that you can get involved within the local community. And also we do have a short survey. So part of the survey is also understanding what other future events are you interested in learning, whether that's as an entrepreneur, an investor, or whatever kind of hat you might have come today. So Kevin just dropped that in the chat. We'll also be sharing this through an email with follow-up and all the recording today. But thank you again for everyone that attended, and we will hear from us soon. So cheers.